Welcome to the Alhambra Investments Monthly Market Monitor. Joe Calhoun is here to tell us what he's seen as he looked at the reports for the month of August. And you've got only a slight smile on your face.
Well, it's kind of a crazy market, Bob. We've talked about that a little bit, but yeah, it's we've had a little correction over the last few days, which makes me feel a little bit better. Maybe things don't just go straight up, but it's been a wild market.
Well, you just finished your report, and one of the things I saw in there, you talked about companies out there with high PEs, and the growth of the stock just doesn't support that. And this is not an isolated incident.
Well, no, I mean, everybody talks about Tesla and Nvidia and all these other high-flying tech stocks, and that's true. And I think a lot of people are making the comparison to 1999, but 1999 was a very different market. In 1999, it was really tech stocks, and that was it. That was the big bubble. I think what's interesting about this market is that everything is very pricey. I used the example in the piece about Procter and Gamble. Trades at 28 times trailing earnings, and it's growing at single digits, 4 or 5% a year. That's a high price to pay for a very small growth rate. And it's not that Procter and Gamble's not a good company; it's a great company. So is Walmart, for instance, was the other example I used. Walmart paying 20 plus times earnings for a company growing at single digits seems a little frothy. So I think when people talk about the Nasdaq and they talk about the tech stocks, that's true. But I think you need to widen your scope a little bit and think about the market as a whole. And in general, growth stocks are very expensive, but the market as a whole is pretty expensive.
Talk to me about what's going on with growth versus value right now.
Yeah, we've seen this huge divergence this year, Bob. I have never seen anything like this. The Russell 1000 growth index has outperformed the value index by about 40% just since the beginning of the year. That kind of performance dispersion is just gigantic. I don't know that there's a precedent for that. Yes, growth has been outperforming value this entire cycle because it's been a strong dollar cycle, and we know that's what happens in strong dollar cycles. Growth outperforms, but the amount of outperformance is just stunning. That'll get reversed eventually when the dollar does eventually go down and get into a weak dollar environment. That's when value will outperform, but when it does, there's going to be a very, very large adjustment, and I suspect it'll probably be in a fairly short period of time. It's going to be interesting to see how that goes. Go back and look at 2000 when growth corrected versus value back then. It happened quickly. So we'll see.
What are you seeing in international versus U.S. markets?
Yeah, same thing. We got the EFA index, which is kind of a broad international index, is down on the year still, down single digits, I think 6 or 7%. I looked the other day. Whereas U.S. is up on the year, so there's quite a divergence there too. Not quite as extreme as that growth versus value, but also another trend that has been really since the last crisis, 2009 till now. International has struggled versus the U.S. And again, it comes back to the dollar. We always emphasize you got to figure out what environment you're in. If you're in whether the economy's growing or not, and it's about rate of change. It's not about necessarily levels or magnitudes. It's about the rate of change, the direction, and also the dollar. Is the dollar in an uptrend or a downtrend? Is it strong or is it weak? In a weak dollar environment, value outperforms, international outperforms. In a strong dollar environment, it goes the other way. It's growth in U.S. So we've been in a short-term downtrend, and we've seen some minor outperformance from international since the bottom in March and April. But it's not significant. It's not significant because the dollar downtrend is really just from the top of the range to the bottom of the range. And until you break out and get into a sustained downtrend in the dollar, you're probably not going to see that international outperform consistently. We have had some outperformance. We've taken advantage of it in our portfolios, but right now we're really kind of on edge because we don't know which way the dollar is going to go from here. We're at a kind of a critical point here.
Well, the dollar has been strong against other currencies, but fairly weak against gold. So what does that mean in terms of markets?
Well, it's just a reflection of growth expectations in the bond market. We've seen rate of change on economic growth has obviously turned positive. We're going to have a big third quarter, whatever the number turns out to be. Huge downdraft in second quarter, big updraft in third quarter. That's just nature of the beast. Big downdraft means big. A big. If you go in a big hole, you come out fairly strong. But the bond market is not really buying it. And we still got the 10-year Treasury note trading at 60-something basis points. And for gold, more importantly, real interest rates, tips, are trading at very, very low rates, negative rates, in fact. The 10-year tip is trading at -1%. That is not a very positive indication about real growth expectations. And as long as real growth expectations are that negative, gold's going to be positive. Look, the dollar versus other currencies is how the U.S. economy is in relation to other economies. And the dollar versus gold is more about how the U.S. economy is on an absolute basis. We're still got a pretty big hole we dug ourselves, and we're not anywhere close to out of it yet.
Well, even though gold has done pretty well in terms of general commodities, I mean, we've seen it spike and we've seen it pull back. What's gold telling you right now?
Well, actually, I think the more interesting signal is out of the general commodity indexes. Look, if you get away from oil, oil's really volatile, and we've had a big pullback in oil over the last few days. So you had a pretty good sized pullback in the Goldman Sachs Commodity Index. But the broader commodities look like they're doing quite well, and that might be related more to China than it is to the U.S. In fact, I'm pretty sure it is. So we've seen copper and some of the agricultural commodities have started to do well too. Wheat and corn have come off their lows. So general commodities are they didn't perform that well in August. And really, to perform really, really well, you're going to have to see the dollar get into a downtrend. And we haven't really seen that yet. But we are seeing some recovery in some of these commodity prices that got really hit hard during this crisis, during this virus episode. But China's making a comeback here. China's economy is recovering, and that does drive demand for commodities. So we're seeing I think, some positive signs from other commodities other than oil. And by the way, I am still convinced that we have shut in a lot of oil production. I mean, a lot. Number of rigs drilling in the United States has just dropped off a cliff. There's going to come a point where demand comes back, and it's probably going to be related to airline travel more than anything else. There's going to come a point where demand comes back and the supply is not going to be there. You're eventually going to see a big spike in oil prices, but apparently we're not there yet.
Well, and Chinese stocks, the Chinese stock market has done extremely well this year.
Yeah, well, China has their domestic economy is recovering. I think people overestimate. Sometimes they think. Somebody told me the other day. They said, hey, why is China doing so well? We've got all these issues with the United States. Well, yeah, the perception is that China's economy is completely dependent on everybody else in the world. That if they don't export a lot, then their economy's bad. Exports as a percentage of their economy has fallen consistently, and it's really only about 17, 18% of their economy now. The United States is 13, so I mean it's not that much different. And ours actually has gone up some, where theirs has gone down. In fact, if you go back to this whole period, way back, a couple of decades, exports as a percentage of the economy have been climbing in the United States the entire time. We talk about, President Trump talks about trade being this big negative for the U.S. economy, but it's just not true. China, though, their domestic economy is recovering, and that's driving what I was talking about with commodity demand, but it's also driving their stock market. They're not as dependent on exports as people think they are.
Well, it's going to be interesting to watch and see where it all goes, Joe.
Well, it is always interesting. That's why I'm in this business. You get up every morning, you have no idea what that screen's going to tell you today. It is a very interesting business. Now, I'll end this. I wanted to talk about we had a big correction in tech stocks over the last few days. NASDAQ actually down 10% in just about 4 days, which puts it in correction territory, which I think is, kind of it's just a random number. 10 is a correction. Okay, sure. It could be -9 or -9 wouldn't be a correction, but -10 is. That doesn't make any sense. But I've heard a lot of people talking about this market and the tech stocks and how expensive they are, and this is a bubble and all that kind of stuff. But these things eventually end. They usually end when we see, I guess, kind of I want to be careful how I say this. When you see people getting involved in the market that probably shouldn't be involved. So I've told you this story before. I'm going to tell it for these guys, for the audience here. But I have two godsons who we shower affection and dollars on at times. What we do is when they make good grades, when they get A's, we give them a cash bonus, and we give them some money to put in their spending money to put in their pocket, and we put money in their accounts at Fidelity. The younger one, who's 11, called me months ago and said he wanted to buy a Nintendo with his Fidelity money, and so we did, and he's done pretty well. His older brother seemed more interested in what he was going to spend it on. He finally called me last week and said he wanted to buy NVIDIA. Now, NVIDIA, in case you don't know, is one of the hottest stocks in the market. And he knew that they had a new chip coming out, and he wanted to buy the stock. And I talked him out of it, thank goodness, because it dropped about $100. And the bottom line is he doesn't have enough money really to buy much because it's a $500 stock, and he's only got $1,000 in his account. Not going to be able to diversify a whole lot with that. But the point is that when I've got high school kids calling me wanting to buy tech stocks, we might be getting somewhere close to the end. I don't think we're quite there yet, but we're getting there. So just if you want to buy tech stocks, my advice, just hang on a little bit, just hang on a little bit, because I don't think we're too far from the end.